And joining me for today's Options Insight is Kevin Kelly. He's Chief Investment Officer at Recon Capital Partners. And, of course, volatility has been a hot topic in recent days. Mario Draghi brought it up yesterday and said, get used to higher volatility. We have mostly seen bond volatility elevated at the same time that stock volatility hasn't been. But you actually say stock volatility might be higher than it appears.
Yeah, so if we go back to last year, the average VIX was around 14. If we look at the 5 months of this year compared to last year, we're actually up a point. And we're actually up even more if we look at 3-month VIX, so from 15 to about 17.5. So if you start looking out, everybody's really anticipating volatility coming up. And we can actually see that from the options action earlier this morning. So someone took Mario Draghi's words literally, and they went out and bought 55,000 contracts on the July 20 VIX call. So they're expecting VIX to go up. And now the overall volume for today is above 107,000 contracts, which is huge, especially on VIX and on the short-term side. I mean, this is out to July. So they're expecting a burst to come in, and they're expecting it to come in over the next couple months.
I mean, what's a typical size trade on the VIX?
Well, it's actually a lot lower, right? I mean, you're not seeing, I mean, that's a big position overall, especially because VIX is kind of a decaying asset. And when you're buying calls, so because VIX is fluctuating so much, I mean, you're seeing, I mean, a 55,000 block is sizable. Someone's actually either protecting their portfolio or making a long bet.
So what are you doing then when it comes to the VIX?
So when you're looking at the VIX, there are several strategies you can deploy. You can actually capture that volatility. You can sell it and actually bring it in on days like this, or you can actually go long it like this person can do. But you can do it on a cheaper facet, and you can do it by doing it in spreads. So you can actually go long a strike and then short a strike above it and capture that premium if you want.
I also wanted to talk to you about the big rumored deal today. That is T-Mobile potentially being bought by Dish or some sort of combination there. And you've got a trade that has to do with that potential deal. What is it? Yeah,
options are a great way to get into this kind of rumor spot because you don't need to pay up a whole lot of money and just go head first in. So what you can do is you can do a call spread like I had mentioned before. So you can buy a lower strike call, the 41 in T-Mobile, sell the 45 against it. You've got a $4 spread, but it's only going to cost you $1.30, and you're actually going to get a great risk-return ratio. And the reason you want to do this is because this rumor is now baked into the price of the stock. There's been a move. It can be expensive to buy outright calls, but you're seeing 10 times the amount of volume in T-Mobile calls today alone. Everyone's out there buying calls. Make it cheaper for yourself. Do it in a spread.
Doing that spread.
Yeah, exactly.
Okay.
And this goes out to November.
All right.